Hello, welcome to Module 8 of the course Personal Finance. So in Module 8, we are looking at personal finance counseling and advice. So this module will equip you with the knowledge, skills, and ethical understanding on how to support others in managing their own financial lives based on what you have learned previously. So this module explores distinct roles, advisory methodologies, and communication strategies to foster financial stability and long-term growth. So, who does counseling? Who gives counseling and advice? So, we'll look at different roles. Understanding the difference between financial advisor, coach, and counselor is foundational for professional training. So, we have in finance, personal finance, we have financial advisor, we have financial coach, and financial counselor. These three, although work together, complement each other, they are different. So these are different roles. So these roles, although all of them offer guidance, they differ significantly in their purpose. There's also difference in their scope, in the method they use, and their ethical responsibilities. So let's start with the financial counselor. The financial counselor is the crisis solver. So he specializes in acute financial stress. He focuses on stabilizing urgent situations like debt. Maybe someone runs into debt, so you meet a financial counselor, or maybe arrears or potential insolvency. Their role is just intervention based and problem focused. So the financial counselor is a crisis solver. Then who is a financial coach? Now the financial coach is the personal trainer. The financial coach is the personal trainer on finance. So he focuses on building strong financial foundations and sustainable money habits. So this role is developmental. It is not intervention based like financial counselor. It is actually developmental because it emphasizes behavioral change, financial literacy, and accountability. So the financial coach is responsible for training individuals on how to manage their finance. So you can see that the role is developmental. The focus is on training so that the individual will not enter financial crisis or will not be financially stressed. Now the third role we'll look at in this module is the financial planner. The financial planner is referred to as the architect of finance. So he operates at a very strategic level because the financial planner helps to design comprehensive long-term financial plans for wealth accumulation, protection, and intergenerational transfer. So if you are confused, you don't know what to do about your finance, who do you meet? Do you meet a financial counselor, financial coach, or financial planner? Definitely, the financial planner is the one for that role. So you have to note the difference between a financial counselor, a financial coach, and a financial planner. You can see the financial counselor is the crisis solver. He just intervenes to solve problems. The financial coach is the trainer, the personal trainer of finance, while the financial planner is known as the architect of personal finance. Now, financial counselors work with individuals that are facing serious debt, just as I mentioned. All right. So they negotiate with creditors, they explain legal rights, and assist with budgeting to prevent future crises. Services are often low or no cost, provided by non-profits, emphasizing accessibility and consumer protection. So that's the focus of a financial counselor. It's actually crisis intervention. They can help to negotiate with creditors. They can help to explain legal rights, also assist in budgeting. Now, for the financial coach, like we said, the financial coach is the trainer. So his focus is on building habits. So financial coaches help clients master core financial principles such as budgeting, goal setting, cash flow awareness, saving discipline, and responsible credit use. they instill structured habits into people. So they act as the accountability partners through regular check-ins. They supervise their clients, they support behavioral consistency. This is actually a paid professional service. It is not free, with fees varying based on experience and service model. So, but the financial planner, who is the architect or the strategic wealth manager, helps to design long-term strategies. Their work involves portfolio construction, tax planning, and even retirement projection. They can help you to project how your retirement will be. Their services are also typically fee-based, and it requires high technical expertise and regulatory oversight. All right. So, but the financial planner have to be trained and have special certifications. Now let's look at the advisory framework. There are 7-step process. Professional financial advice follows this 7-step process. Number one is, if you want to give advice, first you have to understand the situation. You have to make comprehensive fact finding on income, expenses, debts, assets, and qualitative factors like value and risk tolerance. That's very important. So when you have a client that needs advice on his or her finance, you have to first understand the situation. You have to understand the income, expense, debt, asset, or consider other factors. They also identify goals. You have to define SMART goals: specific, measurable, and time-bound goals. This, for instance, you can say eliminate debt within 2 years. Maybe that's the goal of the advice, and the person is in debt. You now say, okay, you want to remove or eliminate this debt within 2 years. You have to have a specific identified goals. Then number 3 step is analyze the path. You have to do a gap analysis to evaluate if the current trajectory achieve goals. You identify performance gaps and also help the client to make necessary adjustment. Number 4 is you formulate recommendations. So practical advice align with client capacity. You make risk profile and also build regulatory standard. Number 5 step is the presentation of the plan. You communicate the strategy clearly to your client, explaining actions, rationale, and expected outcomes in a very easy and understanding language. So next is implementation of the plan. This involves executing a strategy, setting up transfers, consolidating debts, or opening accounts with attention to detail. The final step, number 7, is monitoring and review. There should be ongoing oversight and adjustment for changes in income, circumstances, or economic conditions to maintain progress. So each of these stage builds logically, and it prevents premature recommendation and reducing error risk. So as a financial advisor, you have to follow this framework. This advisory framework will guide you. You don't just rush to begin to make recommendation without understanding the situation, without identifying the goal, and also analyzing the gaps. So it is sequential, it is logical. So then let's talk about communication skill. If you are a financial advisor, you have to be a good communicator. Effective communication, especially active listening, is crucial in financial advisory. So there's what we call the listing model. The listing acronym, listing, LISTEN model, which enhances rapport, clarity, and client follow through by addressing sensitive financial matters. Let's look at them quickly. The first is L, which means learn their language. Learn their language. That means you have to adapt your terminology to clients' vocabulary and literacy. Don't be using jargons to ensure if you are using jargon, they will not understand. So you have to use a language that they can relate with. You have to calm down, because communication is termed effective if the recipient or your listener, your client, understands what you are saying. If you now begin to use jargons, professional jargons, it will confuse the client. The next thing is you have to also identify emotion. Don't forget, we say listening. L is learn their language. I is identify emotions. So you have to observe non-verbal cues to address underlying anxieties. When you are with a client, you have to know when the client is worrying, when he is ashamed, or is full of fear. This will help to foster emotional safety and transparency. You have to identify emotions. Then number 3 is summarize. S, summarize. Summarize means restate key points to verify understanding of clarified facts and allow corrections. So when your client is sitting before you seeking for advice, you have to take note of these key points and try to bring out a summary. Then number 4, tailor responses. That's T, tailor responses. So your recommendations must be aligned with clients' income, risk tolerance, and priorities. So because if the responses are not practical, how will the clients, apply them? So you should ensure practicability and commitment. Then the E is engage with empathy. Put yourself in the shoe of your client. Put yourself in the shoe of your client. All right. So validate client's experience without judgment. Don't judge them. Don't put them down. So this will help to build trust. Shifting interactions from transactional to relational. So when you engage with empathy, when you engage your client with empathy, it shifts the interaction from just the transactional mode to a relational mode. Now the N, that's the final step. N from that listing model is navigate next steps. Conclude. Always make conclusions with clear, manageable actions to maintain momentum, reinforce accountability, and ensure measurable programs. So don't just end casually. Ensure that your conclusion should be very clear to your advisor, so that your client, so that as your client leaves you'll be able to know this is the next action to take. Then there's another model I call motivational interviewing, the OARS model. OARS. The O stands for open-ended questions, A stands for affirmations, R stands for reflective listening, and S stands for summaries. All right, so open-ended questions. So when you are doing interview, the OARS model helps clients overcome resistance to change by guiding reflection and fostering intrinsic motivation. Intrinsic motivation means when the client is internally motivated. All right. So it is a structured approach for advisors to move clients. It helps to motivate clients toward positive financial change without lecturing. Now, the open-ended questions means you encourage deep exploration of thoughts and feelings, uncovering beliefs and obstacles. For instance, you can say, how do you decide what you spend? Start with open-ended questions. Then from there you go to affirmations, where you now tell your client, after talking, now say, well, I appreciate your honesty. Thank you for being honest. Acknowledge strengths and progress. And this will help to build self-efficacy and encourage continued openness. If you don't, maybe after you ask this question, how do you decide what you spend? And your clients open up. You have to appreciate that honesty. And when you do that, it will encourage more continued openness. Now, the next step is the R, reflective listening. You have to mirror client statements to show understanding and empathy, clarifying meanings, and encouraging deeper exploration. For instance, when you say, I appreciate your honesty, or maybe what the client is saying, you keep listening, you now say, well, it sounds like that can cause stress. What you are saying can cause stress. When you are being a reflective listener, it will encourage your client to open up more. Then finally, summaries. Periodically recap conversations to confirm mutual understanding. For instance, you can break in and say, okay, is this what you mean? All right. It will also help to clarify miscommunication and also reinforce key points. Now, let's also talk about needs assessment. Need assessment is just a form of discovery meeting. is for you to know what is even needed. So this discovery meeting is crucial for establishing trust, and it will help you to gather essential financial and personal information about your client. So it combines quantitative data with qualitative insights, to form a complete, comprehensive picture of the client's circumstances, values, and goals. So it is important. So it involves gathering quantitative data and also qualitative insights so that to form a comprehensive, complete picture about your client. So the document checklist you use for discovery meeting include proof of income, spending records, or debt list, maybe loans, mortgages, and credit cards. We also talk about insurance policies. This document checklist will provide an objective foundation for accurate budgeting and strategic development. But there are qualitative questions, the heart of the matter, the crux of the matter, that have to be ironed out. Okay, so because you have to explore clients' beliefs, their attitudes, and how they relate with money. How your clients, you have to know what is your client's philosophy towards money. So first, you have to ask, what is your earliest memory of money? What keeps you awake at night about your bank account? If you won the lottery, what will you do first? Maybe if I give you, now ask your client, if I give you $1 million, what will you do with it first? So from the response of your client, you'll be able to know, you're able to get details about areas where the client is lacking or the areas that need improvement. So these insights will ensure the financial plan aligns with real life priorities, not just numbers. So it is good to ask questions, qualitative ones. How did you spend your last money? The last money you made, how did you spend it? Or if I give you this certain amount of money now, what will you do with it? So these questions are important. It will help you to actually know the kind of client you are dealing with and also know areas where you can be of help. So there are ethics in counseling and handling resistance. What are the ethics in counseling? Ethical practices ensures trust and protects clients, especially those in vulnerable situations. If clients are in vulnerable situations, you have to be ethical in rendering your counseling services. So what are the ethical considerations in financial counseling? Number one, always prioritize the client's interests above your own to avoid conflict of interest. Your target should be the interest of your client. Number two, use the PLUS model. We'll look at PLUS model in the previous recently. So the PLUS model, evaluate decisions. Let the decisions you are making or the suggestions you are giving to the client align with PLUS policies, legal requirements, universal norms, and also self-value. That's a PLUS model. Then you have to be confidential. You have to protect client information. Do not disclose client's information. But you may disclose only with explicit permission from your client or when there is a legal requirement. All right. But you see, some clients can be resistant. So how do you handle resistance? You can handle resistance ethically. You can handle resistance professionally. For instance, don't argue with your client. You should adopt a reflective, non-confrontational approach to understand your client's perspective. For instance, if your client is saying, I understand your part. Don't say, no, what you are saying is wrong. No. Try to understand your client's perspective. Then number two is roll with resistance. Accept client's feelings without judgment. Working with their readiness for change. The third one is validation. Always reassure clients that their struggles are normal. This will help to reduce shame and also foster trust. So you can see that personal finance counseling is a multidimensional profession. It combines technical knowledge, behavioral insight, and even ethical responsibility. We've looked at the listing model, the OAS model. I also look at ethical practices. So What you have learned in this module is a professional foundation to support clients with confidence, empathy, and strategic insight. This will enable sustainable financial well-being and long-term success for your clients. Thank you for listening.